All right, welcome back here to another episode of Connor's Corner. This is episode number 4, and a holiday themed one. So, getting in the spirit of Christmas, just hopefully everyone had a great Thanksgiving. As we turn the page here to December, the 12 thoughts of Christmas. The main 12 thoughts we have today are listed on the screen. Of course, we'll go through each one of them day by day, thought by thought. All right, first off, to tackle the basics, right? We don't want to miss out on the simple tasks that everyone should be taking care of for sure by the end of each year. So if we're a tad bit older, right, we could be having RMDs, right? We are required to take care of those by 12/31 each year. And with that being said, we also, if we need to know the amount to use for that calculation, you go off of the previous year's balance. Okay, so the previous year is 12/31/2024 to calculate 2025's RMD. The next, changes ahead. Okay, are you up to date? Right, in a calendar year, a ton can change. Did you get married? Did you get divorced? Did you have a kid? Did you move states? The list goes on and on. Right, so simple ones, right? Payroll deductions. Are we maxing accounts that we wanted to max? All those things that we need to get done in a calendar year, case by case, but changes could have occurred in 2025, so make sure to recap yours. And lastly, we want to close the year, right? We want to sit back down with our spouse or do some reflection on how things have went this year financially, what went well, what maybe we want to change going forward. So that way we're on the right page starting out for 2026. Okay. One of the most interesting tax strategies that we can employ by the end of the year is tax loss harvesting. Okay, so if you have a brokerage account, right, we've went over these before in the past. So you've got a non-qualified account, and let's say you made a trade in there, you owned Apple and you sold it for a bunch of gains, right? And you're worried about taking the tax hit come April 15th. Well, you can offset those if you have losses in other types of funds, right? If you bought, I don't know, let's use NVIDIA and it was down in your account, right? You could go and offset your Apple gains by selling some NVIDIA for a loss, okay? So you can offset the gains, but also anything above $3,000 in losses carries forward, okay? This is a big one that I always like to talk to about with older clients. To go on a grim side here is that at your passing, your capital losses that have carried forward from potential previous years do not pass on to your to your kids, right? Or whoever I should say your beneficiary wants to be. So using all of them up can be a tax play to increase your basis and of course not be being taxed with capital gains. All right, next is estate planning. Okay, and this is one of the top 3 things that I always talk about. Whenever there is a big life event, okay, you should be updating your estate planning, having a will, having a trust, power of attorney. Okay, these are things that need to be looked at annually, but are usually put on back burner. Okay, and so as we look to the holiday spirit, where you're sitting around the table with friends and family, probably who are which, more than likely, are your beneficiaries. If you want their life to be easy, if some unforeseen event would happen to you, make sure your estate planning is up to date. I see headaches all the time where people who own a business don't have their estate planning set up, and then all of a sudden their kids are handed a business and they have to run it, and they don't have access to bank accounts, and they don't know what they're doing, and they don't have a buy-sell agreement. There's a ton of things that estate planning can solve. So, and this is not just end of year, this is a good time to highlight it, but anytime that you have a big life event, you should be redoing some of your estate planning or evolving, okay? And as I recommend there in the bottom, every 3 to 5 years at minimum, you should be doing this. Okay, there's 4 main tax deductions or investment accounts that we can utilize. Okay, one being the IRA or the Roth IRA. Okay, now you do have up until April 15th of 2026 to fund for 2025 outside of the backdoor Roth IRA, which we talked about in previous videos. Okay, so make sure as we're sitting there doing our internalizing, I should say, how things went this year on a finance. Is it time to max that account? Did you max it out yet? So be on the lookout for that. 401k, okay, we have until 12/31. So if you're a person who wants to dump money into your employer plan, you've got till 12/31 to do so. Education, right? So we had a child, we want to do a 529 plan, okay, or something along those lines. We have until we have until the end of the year there to make those contributions. The easy way. There are some states that allow you to go and do a post date, so it's state by state, but good rule of thumb, of course, is to do it in the calendar year. And then FSA, HSAs, okay? So we can backdate these contributions. It's also the time of year that you're going to be selecting your health plan if you want to make an adjustment, okay? And so thinking about these type of accounts might lead you down the road to selecting that correct health plan, all right? Which leads me into this slide, right? So healthcare decisions, all right? So someone who's on private insurance or whatnot through an employer, these end of year open enrollments happen in November, December. And then someone who's on a Medicare plan, a little bit different time that you can elect in there as well. So it's case by case there. But note the end of year here, we're redoing our healthcare plan looking forward to 2026. So make sure you've got an idea of what you want that to look like. Maybe a higher deductible will lower your monthly premium if you're a very healthy individual and want to bank on that, or you want to adjust it, maybe pay more of a monthly, but to have a less deductible if you know next year you're going to get that surgery, you're going to do something along those lines. So make sure you're up to date with your healthcare. All right, not going to talk too much about Roth conversions. That was episode 3, okay, where I went in depth, really, really extensive there. So note these Roth conversions have to be done by 12/31. So it's a huge component, of course, of year-end planning, which is why I wanted to highlight it again. But note that it has a ton of things. Medicare, I should say, it affects a ton of things potentially. So talk to your advisor, talk to your tax preparer, whatnot, to do a projection if a Roth conversion could be right for your financial plan. All right. In the holiday spirit, we're always looking to gift something that we love to, or gift something to our loved ones, right? In turn, a lot of people who are older and have money and want to see their kids use it while they're still alive versus waiting for them to pass away before giving it to their kids or whatnot, comes in the annual gifting, okay? This is something that you can do. The annual gift tax allows you to do $18,000 per person, per recipient, per person, okay? So $36,000 for a married couple. So this means that you can give your children cash, right? And it will not be taxable to them or go against your lifetime gifting amount, okay? This is something that's unique, and not many people, of course, do this, but I wanted to mention that there is an opportunity for you to take advantage of that $18,000 per recipient, by the end of the year here. This one is more in line with something that I see clients do all the time, or maybe honestly they should be doing, but do not know about it, okay? I'm going to move my face over here, all right? Which is qualified charitable donations, okay, or the QCID, okay, as we call them. All right, so this QCID, okay, is a tax strategy that allows individuals who are 70 or older to donate up to $105,000 directly from their IRA to a qualified charity, okay? This is very, very important. It has to go directly from your IRA to the charity. Okay, it cannot go to your pocket, then to the charity. If you do it that way, it has to go on your Schedule A, which is standard versus itemizing. And if you do not have enough charitable donations or other areas to write off, you technically don't get to use those charitable contributions, or charitable donations, I should say, to help your tax situation. All right. So there's some key factors I mentioned, 70 and a half. Okay. If you're over that, then you can do this. It can satisfy an RMD, right? In distribution, I was saying must come from an IRA or inherited IRA. Okay. So very, very special point. If you the way this works and helps you out, right, is if I take an RMD, and of course that dollar for dollar is going on my tax return. Well, if I do a QSID and let's say my RMD was $10,000 and I decided that half of it was going to go to a qualified charity, instead of having $10,000 on my tax return, I would only have $5,000, right? So that $5,000 could keep you under that next tax bracket threshold, Medicare threshold, something of that nature, when you were probably going to give it to them regardless. It's just a new way of doing it. So this is a huge, huge, huge strategy for someone who really does, normally gives to charities. So make sure that you're taking advantage of this opportunity. The easy one here, but what clients, I feel like I get a lot of shocked faces come tax time, is just projecting your tax liability, right? So at the end of the year, it's a great time to reach out and just do a quick consultation and say, hey, here's my final pay stub. I did this Roth conversion. I'm going to fund an IRA, blah, blah, blah. That could have affected you, right? Am I withholding the correct amount, or am I going to get hit with a huge unforeseen tax bill, right? Or, of course, a big tax return. So easy one, but project out your current tax liability so you're not shocked come April 15th. All right. If you did do that tax projection and found out, hey, I'm going to have a pretty big balance due, it might be smart to do an estimated payment. Okay. And I say might be because there are some caveats, in my personal opinion, of when someone should do estimated tax payments. All right. And here's the main reason why, okay, is that you could have penalty interest if you are not paying enough tax throughout the year to the IRS, all right? And so with that, there's some rules that go into, do you qualify to have that penalty and interest, okay? You have to pay 100% of the last year's tax liability, or 110% depending if you're over an AGI threshold. Majority of people need to pay 100% of the previous year tax liability, okay? Or the other way to do it is 90% of the current year. To put this into numbers, let's imagine you make $100,000 and you withheld $0 in tax the whole year, okay? Well, you are supposed to pay 90% of that. So let's imagine your tax liability was $10,000 to make it easy, okay? So you owed $10,000 on your $100,000 of earnings. Well, you should do an estimated payment of at least $9,000 to keep you out of penalty and interest. All right. So doing these by the end of the year has a better chance of keeping us out of those penalties and interest. And of course, if you're paying it now, which means at tax time, you'd owe the difference and won't be hit with some big amount at one point. Okay. Lastly, the simple way is just how to pay them. You can go on the portal, or you can send it via check or go onto their website. So very, very simple on how to pay those estimates. Okay. Another good one to look at is just your investment philosophy. All right. So most people, and I say most because I do have clients that want to stay riskier the older they get, or a life change happens, something along those lines. But your investment philosophy changes over time, right? Majority of people, as you're young, you're willing to take on more risk. As we get older, of course, we want to come off that risk because we might be needing to pull from those accounts, or quite honestly, don't like the stress of seeing your account go up and down because you're watching it a little bit more, right? Each year, you'd be surprised how clients don't realize what their risk profile is. Okay. Hey, I really like being a 60-40, and then you look at their account and they're 80-20, right? And they're super aggressive. Or the other way, right? Hey, I like where the market's at right now. I want to be more aggressive. Well, you're 50-50, sir, ma'am. You're not matching what your philosophy or your goals are. Okay. So this is a great time of year to just do a quick, hey, what's my investment philosophy? Am I on track? Does it match up with how I personally feel today? Right. So make sure you're looking at that. Again, just a good time of the year to kind of do a look back, see that everything's in the right spot, so you start off with a great launch board for 2026 and going forward. Okay. As I say, we want to make each year our best year, right? So 2026, as the ball drops here in a short month, we want to make that our best year yet, right? And so refocusing all those priorities. It's the New Year's resolution mindset. Hey, this year I want to max my 401k. I want to max a Roth. Well, if you wait until the end of the year to make that happen, it's going to be much harder to achieve that, right? So getting out on a clean slate is really important. So taking the time at the end of 2025 to evaluate where you're at in life, what are your new goals, will allow you to hopefully check more of those New Year's resolutions off versus saying, you slacked off on them yet again. Okay. So as I say, there's some, you want to refocus on priorities, measurable tracking. Okay. That's always something that people make goals and they're not measurable, right? Instead of saying, I want to invest more money this year. Well, say I want to invest this much. And then that allows you to say, hey, per month, I'm going to do X amount of that. Okay. So if you make them measurable, they have a higher percent chance of coming true, right? They can motivate you. Hey, we said we were going to do our estate planning and we didn't this year. If something really bad happened to us, we'd be putting our kids in a tough spot. Motivates you, right? Along with maybe you got married, right? And your spouse and you haven't had a conversation of what their goals are and what yours are. Well, I see that as one household now. So getting on the same page with your spouse means that you're pushing the rock up the same mountain, right? And as always, planning versus driving in the dark with no headlights. We always want to have a plan, whether that's a simple plan, right? Just a couple of steps, or a very, very complex one. A plan is better than no plan. Okay. Short and sweet video here as we look just with a couple simple points as you're enjoying hopefully some time with family and friends. And you ate a bunch of food and are looking to just have a good holiday season. So 2026, the first video, we're going to go over some key tax changes for your 2025 return. Okay. And then going forward, as always in each video, we'll talk about the next key highlighted one where we'll eventually go over funding limits that will increase for 2026 and on from there. As I always mention, we have our 3 socials that you can follow and we would appreciate it, right? So we've got our YouTube page, the Facebook page, LinkedIn. So join us on there so you don't miss out on any future content. And I just want to thank you. I hope you have the best holiday ever. It's going to come and go. So enjoy that time with loved ones because that's what it's all about. Have a good one. Happy holidays. Merry Christmas.